What if I told you that the absolute best defensive stock for 2026 just reported a massive 70% drop in net income? Seriously, stop what you're doing. If you own utility stocks right now, or if you're just hunting for bulletproof dividends to weather the next market storm, you absolutely need to see this fundamental breakdown. See, last week I ran California Water Service Group, ticker symbol CWT, through 5 rigorous valuation models, plus the legendary checklists of both Warren Buffett and Peter Lynch. And honestly, what I found hidden underneath that recent earnings miss completely shocked me. Welcome to this explainer. Look, I know the biggest fear for retail investors right now is accidentally buying into a yield trap right before the market turns. We've all been there, right? So today I'm going to give you a clear, actionable framework that you can literally steal to evaluate these utility stocks. And by the end of our time today, you'll know definitively if CWT is a Warren Buffett dream buy or just a classic Peter Lynch value trap. Okay, let's dive right into this framework. First off, I want you to ask yourself a pretty bold question. Why on earth would a top-tier utility company see its net income just totally fall off a cliff right before a massive regulatory payday? I mean, on the surface, California Water Service Group really looks like it's struggling. But actually, scratch that. It's more like a tightly coiled spring. This whole market setup might just be hiding one of the most explosive fundamental rebounds we've seen in the entire utility sector. Because when you're hunting for true intrinsic value, you've got to look past those immediate reactionary doom and gloom headlines. You need to dig into the structural catalysts that are literally just about to trigger. And for CWT, the weird timing of the recent reporting, well, it created a perfect storm of completely misunderstood data. Let's just look at the stark reality of those Q1 numbers for a second. First quarter net income absolutely plummeted to just $4 million. That's about 7 cents a share. Now compare that to the $13.3 million or 22 cents a share that they pulled in during the exact same quarter last year. Yikes, right? That is a brutal 70% drop. Honestly, if you're just skimming the headlines, you'd probably run for the hills. For anyone trying to build a stable, income-generating portfolio, a sudden drop like that sets off every single alarm bell in the Peter Lynch playbook. I mean, it looks exactly like the kind of value trap that burns retail investors who are just blindly chasing yield without understanding the underlying mechanics. But wait, here is the critical context that the mainstream headlines completely miss. That Q1 dip, it was really driven by a few temporary surface-level culprits. First up, crazy climate variability led to a drop in customer water consumption. People just weren't using as much. Second, they took an $8.3 million hit from increased wholesale water production costs. But here's the absolute linchpin of this entire setup, so pay attention to this. These Q1 numbers reflect old rates. Their long-awaited 2024 general rate case had been severely delayed by regulators. So basically, for the entire first quarter, CWT was operating with one hand tied behind its back. They were absorbing all these higher costs without the legal ability to pass them on. It completely artificially compressed their earnings. But then, the calendar turned to April 30th, and boom, $90.5 million. The California Public Utilities Commission finally adopted the revised proposed decision authorizing a massive $90.5 million revenue increase for 2026. And you know what the absolute best part is? It is entirely retroactive to January 1st. So that terrible Q1 earnings report we just talked about, it completely excluded this massive influx of cash. The market was pricing the stock based on constrained earnings, entirely missing the fact that a huge guaranteed revenue back payment had just been legally approved. This is exactly where the Buffett checklist starts letting up like a Christmas tree, right? Finding a fundamentally sound business that's temporarily mispriced just because of a bureaucratic regulatory delay. In the cascading effect of that decision, it's incredibly powerful. We aren't just talking about a one-time bump to fix a bad quarter. No way. We're looking at a finalized, multi-year runway of guaranteed revenue growth. Check this out. A 10.9% rate increase in 2026. Followed by 4.7% in 2027, and then another 5.1% in 2028. The whole financial math for CWT over the next 3 years has completely and fundamentally changed. Let me tell you, in the utility sector, having this kind of transparent multi-year visibility is exceptionally rare and highly valuable. It allows management to plan aggressively, and it gives us, the investors, a crystal clear projection of future cash flows. It pretty much completely insulates the stock from all the usual macroeconomic guesswork. Now, what about that climate variability and dropping water usage we mentioned earlier? Well, enter the sales reconciliation mechanism. I know, it sounds like some heavy, boring regulatory jargon, but this thing is an absolute golden moat for investors. It's basically a regulatory tool approved in the rate case that allows Cal Water to adjust their sales forecasts annually. In plain English, it means they recover their fixed costs regardless of how much water customers actually use. Literally, if it rains for a month straight and nobody waters their lawns, CWT still gets paid. They're brilliantly protecting their revenue from unpredictable weather, which totally neutralizes one of the biggest traditional risks in the entire water utility space.
With that guaranteed cash flow and serious downside protection firmly in place, CWT is going on the offensive. The CPUC just authorized an eye-watering $1.45 billion, yes, billion with a B, for critical infrastructure investments from 2024 through 2027. We are talking about massive rate-based growing upgrades, things like improving water quality, huge pipe replacements, and beefing up cybersecurity. And listen, this isn't just routine maintenance to keep the lights on, it's a regulated formula for long-term, compounding growth. Because every single dollar they invest into this infrastructure earns a guaranteed rate of return that's already approved by the state. This massive pipeline of capital deployment pretty much guarantees their earnings base will systematically expand year after year.
And this infrastructure build-out is really just one piece of their broader expansion strategy. See, they aren't stopping at the California border. During the quarter, they announced a $218 million acquisition of Nexus Water Group. This is a brilliant strategic purchase because it adds roughly 36,000 new customer connections and expands their footprint directly into Nevada and Oregon. So they're effectively diversifying their regulatory risk and capturing fresh growth markets outside of their home state. This bold move cements CWT as the absolute largest investor-owned water utility in the western United States. That gives them unparalleled scale and some serious operational leverage. So what does this perfect storm of guaranteed rate hikes, regulatory protection, and strategic geographic growth actually mean for you, the shareholder? Honestly, it boils down to one staggering figure: 325. That is the astonishing number of consecutive quarterly dividend payouts CWT has made. Just think about that for a second. We're talking about over 80 years of uninterrupted payouts. They have maintained that dividend through massive recessions, double-digit inflation spikes, global crises, and absolute market crashes. It is a level of historical reliability that very, very few companies on the planet can match. But wait, the follow-up number here, 59, is what really elevates them to stock market royalty. Not only have they paid a dividend for 325 consecutive quarters, but they have actively increased their annual dividend for 59 consecutive years. That makes them a certified dividend king. This kind of streak is literally the holy grail for income-focused investors. It proves, without a doubt, that their management team doesn't just prioritize shareholder returns when times are good. They've structured their entire business model around consistently growing that payout for over half a century, completely regardless of the macroeconomic environment. So, the really crucial point here is this: CWT's dividend metrics right now are incredibly attractive. We are looking at a $1.34 annualized payout, which was just bolstered by a really confident 8% increase. That gives you a current yield of around 3.1%, and with the dividend cover of 2.0, meaning their earnings actually cover the dividend twice over, that payout is exceptionally reliable, with plenty of room left for future growth. This incredible track record and fundamental safety net makes CWT an absolute fortress for retail portfolios looking to mitigate their downside risk. Which brings us to our final question. With newly guaranteed multi-year rate hikes that are retroactive to January, a massive $1.45 billion infrastructure pipeline, strategic geographic expansion into Nevada and Oregon, and 59 years of truly unstoppable dividend growth, is CWT the ultimate defensive stock for 2026? Look, that Q1 earnings miss was nothing but a temporary mirage. It was hiding a fundamentally elite utility with a seriously explosive runway ahead. I highly encourage you to apply this framework, dig into these numbers yourself, and see how this fortress-like asset might fit right into your own portfolio strategy. Thanks for joining me on this explainer, and as always, keep learning.